Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Fidectis. Go to www.fidectis.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me is Jeff McAulay. Jeff, welcome back to the program. How's it going today?
Wonderful. And today's topic, risk management in renewable energy, one of my all-time favorite topics. So really excited to dig in.
Well, now that we found out you're a total energy geek, let's introduce our guest, Brock Mosovsky. Brock, welcome to the program.
Hi, Chris. Hi, Jeff. Thanks so much for having me. I'm really excited about today's conversation.
And Brock, you're a co-founder of a company called cQuant. Why don't we start by telling our audience who and what cQuant is and what you do?
Yeah, I would love to. So cQuant.io is an energy-focused software as a service platform for analytics. We provide a cloud-native solution to model and do asset valuation and portfolio risk management and portfolio optimization across a broad range of energy stakeholders. Independent power producers, renewable developers, renewable off-takers, virtually anyone that has exposure to wholesale electricity market prices. And we're also global. So we analyze portfolios today across 5 different continents. So very relevant, I think, to today's topic.
That's fantastic. And I'm so excited to learn more about this, in particular around some broader trends that you might be seeing in the renewable energy market. So historically, we've seen utility scale solar really dominated by utilities, and that's shifted maybe in the last 8 to 10 years to be the corporate virtual PPA. And I would say, at least in some parts of the world, that's continuing to shift, where it's now some percentage merchant in addition to corporates. What, if you would talk about the high level trends that you're seeing, hub, node, would love if you can share a few insights from what you're seeing from your perspective in the market.
Yeah, for sure. It's a very rapidly evolving space. And so I'll echo some of the things that you mentioned, which is, a lot of utility scale solar at the outset. Utility scale wind was primarily being off-taken by utilities, by load serving entities. We saw this really big transition to corporate entities that are pursuing aggressive sustainability targets, just buying a lot of direct renewable energy purchase through power purchase agreements. And that really started, I would say, it started with some of the really big players, the Microsoft and Google and Amazon, and the ones who were really focused on kind of achieving aggressive sustainability targets. Maybe 10 or 15 years ago, they started that really in earnest. And a lot of the other commercial organizations kind of followed suit there. We saw a transition away from node settled contracts more to hub settled contracts through that process, because a lot of those entities, those commercial entities, they either have their native power position, which is generally short, right? They're running data centers, they're running office buildings, they have a short position in the market. But most of that is more tightly tied to the hub than the node. And so there became, with that and with the kind of increased competition in the market to sell power purchase agreements, offering these hub settled contracts became kind of a value add. And what we're seeing today in the corporate space, at least, is that almost no node settled PPAs are being signed. Almost everything is at the hub. That much better aligns with the risk exposure of these corporate entities than a node settled contract. And the off-taker then is exposed to all that basis. So there's potentially another emerging trend where we're starting to see more interest in merchant generation again. Some of that could be due to some of the elevated pricing that we've been seeing over the last couple of years, particularly as gas prices have been really elevated and power prices have been up. Merchant assets have looked really good over the last couple of years. Whether that's a trend that continues, through the next 20, 30 years of an asset's lifetime remains to be seen.
Great. And I know this is a podcast designed for insiders, but I always get confused from time to time. So I want to make sure that we review when we talk about hub versus node. So we are talking about deregulated markets. And if you could go through, we're talking about locational marginal prices, and these are either very deep, highly traded nodes, or the more distributed. How you can give a better definition.
Kind of an overview of that. That's an important kind of foundational bit of knowledge for sure. So most of a lot of the power purchase agreements that we're seeing are in what are the competitive power markets or the deregulated power markets. These are the regional transmission operators or the independent system operators around the country. Markets like the California ISO, ERCOT, PJM, New York, New England, MISO, SPP. The contracts then, the power purchase agreements, are basically an agreement between a seller of energy or an owner of the asset and an off-taker of the energy. And it can be either physical or financial, but generally the off-taker is taking on at least the financial exposure for the energy, as well as off-taking the attributes, the renewable attributes. And that's a really key component of the puzzle, right? That's really why these corporate entities are out there procuring renewable energy, is that these renewable attributes, the renewable energy certificates, are what they are using to claim sustainability for that energy. Now, the contracts can settle at the node, and a nodal price is the price that is locational in nature. So every location on the grid has a separate price. And it's also marginal in the sense that it indicates the kind of value to the grid of adding one additional megawatt to the grid. And of course, the supply and demand, because energy is essentially a non-storable commodity, the supply and demand is constantly being balanced. And so in the US power markets, I think there's over 100,000 different nodal prices across just the deregulated markets alone. At any given instant in time, every single one of those could have a different price, right? And so that's when we say a node settled power purchase agreement, it's very, very locational, very specific to a given place on the grid. And those nodal prices tend to be much more sensitive to local fluctuations because it's just one single point on the grid. So it's much more sensitive to congestion on transmission lines. It's much more sensitive to very regional, local supply and demand dynamics. A hub is essentially an aggregate of many nodes. And it's kind of a synthetic quantity that is traded on in the market. So if you have financial derivatives being traded in energy markets, those will typically settle at hubs, not nodes. And so it's a regional center. So in the California markets, you have a northern hub, NP15, and you have a southern hub, SP15, and you have kind of a central hub, ZP26. And that's where contracts are traded. That's where financial products generally settle. And those prices can detach from the nodal price, and that generates what's called a basis spread. And that's an extremely critical thing to understand when we're talking about renewable energy, because that basis can be very material to the value and risk for renewable energy itself, physical energy, and also contracting.
But I guess that leads to some risk. And, if you go to a renewable portfolio, right, it's intermittent and it's slightly different than we've done energy in the past. So how does this all play out in when you're starting to look at the risk exposure that folks have with renewables as opposed to maybe a standard baseload and traditional generation?
Yeah, it's completely different. And the biggest difference is the non-dispatchability, right? That's really, then this is, at this stage of the game here in 2023, the idea of intermittency and the idea that that is a fundamentally different paradigm than centralized dispatchable thermal generation is nothing new. But I will say the market is still grappling with how to manage those risks. And that's something that, cQuant is very, very involved in, is helping to understand those risks. The big difference is that when you have a centralized dispatchable generator, you essentially have a gas pedal, right? It's like when you're driving your car, if you need to ramp up the generation, you step on the gas. If all of a sudden market prices become, uneconomic, well, you hit the brakes, right? You either ramp down or you shut down the generator. And so you're avoiding these periods of uneconomic market prices. So you're avoiding losses and you're taking advantage of periods where the economics is in your favor, right? So you have essentially a real option. And there's value to that optionality. There's also risk mitigation inherently baked into that optionality. When you look at renewables, you don't have that optionality. There's to some level you can curtail the asset when prices get really bad, but then of course you're losing your production volumes and the associated attributes as well. And so generally, you don't have any control over when the wind blows or when the sun shines. And these assets are just converting weather into electrical energy. And so the risk management of those assets, rather than managing a portfolio of options, really becomes managing a portfolio of distinct statistical profiles, right? Because at the end of the day, a wind farm and its generation is essentially a statistical profile. It has some maximum output. It has, the minimum is typically around 0 if the wind's not blowing. And then you have some seasonal signature, and you have a diurnal signature, and you have a variability around those. And 2 different wind farms that are spaced even just a couple miles apart can have pretty significantly different generation profiles because of the way that the wind blows, because of the way that, the topography is kind of, moving wind currents. The same thing for solar facilities. So it's really becomes developing a deep understanding of the statistical profile of generation and how that profile aligns with the pricing. And again, either the nodal pricing, if you're looking at the physical value of generation, or the hub pricing, if you're looking at a contract that may settle elsewhere. So that's really the biggest difference. It becomes kind of an exercise in statistics and really understanding at a deep level what is driving value and risk, and that overlap between the P's and the Q's, right? The price and the quantity of energy that's generated.
So let's talk about basis risk, because that's a question that I get all the time. Will you handle basis risk? So who's handling basis risk? And in the virtual PPAs, just to be clear also, not to be confused with tax equity eligible basis, a nice general confusing term. We're talking about hub node spread. The name of the game in VPPAs with corporate counterparties seems to have been try to pass the buck if you can. And then the corporate counterparties got smart and they said, no way, we're not taking basis. Nobody wants to take basis risk. So I guess, is that the number one question that you hear in the market, or say one that is bigger than that? And what are people doing to manage basis risk? Is there something out there financially to manage that risk?
Yeah. It's definitely one of the biggest questions that we get asked, and one of the biggest drivers of risk and or value within these virtual structures, virtual or physical. And the idea of this basis, right, again, is the idea that the contract itself can settle at a hub location, but the energy, the physical energy, is still valued at the node. That's the physical energy is always valued at the node. That's where the energy is being injected onto the grid. That's where the locational marginal price is valid. Any hub settlement is a purely virtual construct, right? It's just an agreement between 2 counterparties that says, yeah, okay, I know that the energy is really valued over here, but I am going to look at this price over here that's correlated, but it's not going to be exactly the same. And I'm going to value this financial contract over here. And that opens up this basis spread between the physical and the financial. Now, exactly what you said is what we've seen happen, is that initially the corporate entities were just accepting these node settled power purchase agreements, which meant that the corporate itself was exposed to that basis, because often their load, right? Take the example of a large corporation that's running data centers, right? They've got these data centers that are very energy intensive. They run with essentially just a very flat load profile. The computers, the servers are running, day and night. So there's not much hourly shape to that load. And also the corporate entities that are owning and managing these data centers are typically on retail rate structures where their cost of energy is much more tied to a particular market trading hub than to a specific node on the grid. So when those corporate entities were buying node settled power purchase agreements, what could happen is that the nodal price could take a dive due to congestion on the lines, right? Congestion is basically a phenomenon where the line is exactly that. It's congested. There's not enough kind of bandwidth on the line to push the generation through, and that causes the market prices to decline. So if a corporate was buying power through a PPA as a hedge against its load, what it would generally be seeing is that the hub price could be very high, which means it's very expensive to satisfy load, and the nodal price could be very low, which means the value that they're getting from the PPA is not doing a good job at offsetting their increased costs at the hub, right? If those two tracked perfectly, they have a short position at the hub and they have a long position at the node. And if those are the same price, there's a perfect offsetting of risk there. In practice, they were getting kind of burnt by the fact that the nodal prices were typically lower. So as the gold rush, so to speak, happened, where more and more corporates were getting into the market to buy these power purchase agreements, and more power purchase agreements were being offered, the developers that were offering these deals needed a way to differentiate themselves. And what they did was start baking in contractual structures that were more favorable to the off-takers as kind of a, hey, buy my PPA because I'm not going to expose you to that nodal basis risk. And that became very commonplace. And again, we work with a lot of large corporate entities. I haven't seen a node settled PPA that a corporate was signed for 5 years. It's just not happening at all. And so what happens is now the developers wear that basis risk because they are now offering a hub settled contract. Their cash flows, right? The developer's cash flows, the seller of the PPA, those cash flows are defined by the hub price, but the value of the energy is defined by that nodal price. And so the developers are now building portfolios, or the owner operators of these assets are building portfolios of basis exposure. And managing those portfolios really requires a very locational understanding of what that basis is looking like. It requires an acknowledgement of diversification across the portfolio, and that can either be by asset class or by location, right? You have a diversity of different basis relationships, even within a particular market. And you also have various different diversification that you can get from combining wind with solar or other generating assets. So bit of a long kind of circuitous way to get there, but there's been a dramatic change in the contracting as far as basis is concerned, and I think now that basis primarily lies with the seller of the PPA, whereas 10-15 years ago it was with the off-taker.
In my experience with energy, right, there's a couple things you could do, right? I think we can use financial contracts or derivatives or some other way to hedge and do some sort of hedging. But with renewables, there's this whole concept of storage and battery, right? So how do batteries play in? The description that you just gave shows an electron kind of needs to be used in real time. It's out on the wire, and I kind of need to use it. But if I could store that, couldn't I play with those rules a bit?
A bit. You can. Yes, it's something that it's a primary focus, I think, across the entire industry right now is the idea of using the flexibility of batteries to time shift when the energy actually hits the grid, right? There's many different value propositions of batteries. I think time shifting energy is just one of them. You'll hear ancillary services thrown out a lot. That's things like frequency regulation or spinning reserves or responsive reserves or various different kind of capacity products that are in place to make sure that the grid remains reliable. But in terms of combining these batteries with renewable energy, one of the goals is to add some flexibility there at the margins and to be able to shift energy even just by a couple hours and even just a small amount to kind of avoid instances where you might have a lot of congestion, even at a regional level. So even if you have a hub settled contract, I mean, we're seeing hub prices now that are going negative. That used to be a phenomenon that was primarily only in terms of nodal prices because they were so sensitive to the locational dynamics. Now NP15 goes negative all the time in California, right? And you're seeing that at other hubs around the country as well with the penetration of renewables. And so some of the hope is that these batteries can shift energy around so that if you see a negative price, the battery can actually suck up energy from the grid, right? A negative price for power is kind of it's a bit of a unique attribute of electricity as a commodity. You don't typically see negative prices for other commodities because they can be stored. And so if you had a negative price, that's basically saying, I will pay you to take this commodity, right? Well, that's great for a battery because the battery can soak up that energy, get paid to actually consume energy, hold that energy for a few hours until the price goes back up, and then dispatch it to the grid. And that's called arbitrage, right? And that's one of the big value drivers for batteries in today's market is to arbitrage price spreads. And the fact that the battery is being sited with a renewable resource, by arbitraging those price spreads, you're actually adding flexibility to that renewable resource in terms of when its energy actually goes on the grid. So instead of feeding that solar energy into the grid when the price is negative, which means you have to pay to put your power on the grid, you instead divert it to a battery. The battery can soak that energy up, hold it for a few hours, and dispatch it when the grid actually needs it and when the price is reflective of that. So batteries can be a really good physical hedge to renewables, but of course there's a limitation in terms of how much energy they can hold.
So one of my favorite apps here, ISO Today, since we're talking about California, the best way I've seen to visualize what's going on at the nodal level. So I'm zooming in around San Luis Obispo. It looks like a negative 33-cent nodal price. So, and if we zoom out here, it's actually a good chunk of Southern California is at the lower end of the scale. I love looking at this because you can really track just how weird these phenomena are getting. And same thing in Texas. When I've looked at batteries in the past, energy arbitrage just isn't a very big component of the value. And so do we actually have hope here? You talked about diversification. If I think about a diverse portfolio of basis risk, it's all going bad, all for the same reasons all over the country. And even with batteries coming on, if you've got one battery at one node, you've got one battery at one node. It isn't really systematically helping something that might be across town in the adjacent zip code. So are you sitting here from a perspective saying, we need to raise the alarm. This is bad. It's not being managed well. Let's manage it better. Or do you have actually a point of optimism where you can say, if we combine flexible load and batteries and financial risk management, maybe there's a way to solve this? Which end are you on of the optimism versus alarm raising?
Yeah, I tend to be a centrist in most aspects. So I think there's some reasons for alarm and there's some reasons for optimism. And I think that in terms of batteries, you're right that plopping a battery down at a particular node, there is a limit to what it can do. You're restricted to those nodal prices, and in a lot of cases, if you're looking at energy arbitrage, sometimes the battery can actually eliminate some of that price volatility that was there in the first place. So in some way, batteries can kind of cannibalize their own price dynamics that they rely on to make money and to remain economic. At the same time, batteries are extremely flexible, and there's many different ways that they can provide value to the grid, right? I mentioned just briefly ancillary services. And in today's market, almost all the batteries that we're seeing are driven, their economics is primarily driven today by regulation up and down. And in some cases, spinning reserve or kind of the analogous counterpart for the market. Now, generally, there's consensus in the market that the ancillary services prices will drop pretty precipitously within the next 5 years. And that's really due to market saturation. It's that the grid only needs so many resources that can provide frequency regulation. And once it's regulated the frequency, there's not really a need to regulate it anymore, right? So after you have enough batteries on the grid and that frequency is regulated, there's two things that can happen. Either the additional batteries won't get their bids accepted because the market says, look, I only need this many megawatts of reg up. And I have way more than that being bid in by battery storage assets. And I'm just not going to accept all those bids. The other thing that will likely happen is that the prices will go down from a supply and demand perspective, right? So there's a lot of kind of consensus. It remains to be seen how this plays out, but generally the market has consensus that ancillary services prices are going to tank within the next 5 years, essentially nationwide because of all the battery deployment. And so the battery's flexibility to be able to provide energy arbitrage, it remains kind of, it can just shift the way that it's making money. And as the renewable adoption continues, you're going to start to see these price spreads widen, just like the duck curve phenomenon in California, right? And energy arbitrage may become quite more important, of higher importance to the grid and to the battery's economics. And so as those prices, as the shapes within the day of prices widen, the difference between the lowest price and the highest price becomes wider, and that creates a bigger arbitrage opportunity. So I think that the flexibility of batteries is really the thing where I have the most optimism. There's so many different ways that you can leverage a battery. There's a resilience aspect of it. There's a frequency regulation revenue stream. There's energy arbitrage. And as the market evolves, the battery is flexible enough to adapt its revenue strategy to kind of align with an evolving market.
And batteries are hot right now. So that is a point of optimism. Even merchant batteries taking advantage of the ancillary today, energy arbitrage tomorrow kind of approach. So that makes sense. You also said the magic word, duck. So now we have to talk about all of the different I've seen a few different utility load profile curves with names. I think in Hawaii they had like a Loch Ness monster. California also had an elephant, or is a whole zoo if you start to look at these load profiles long enough. So how worried should we be about the duck curve? And maybe put this in context for us. We're not talking about basis risk, we're talking about shape risk and solar capture value, wind capture value. So where, again, maybe same spectrum, alarmist versus optimist, where are you when it comes to shape risk?
Yeah, and just in the interest of clarity, maybe I'll back up and just define what I mean when I say the duck curve. I think for a lot of people that's probably a term that resonates, but the CAISO years ago, I think this was like in 2012 or maybe even before that, put out a forecast related to the increasing adoption of solar in the state. And what's happening, what they forecasted to happen, and it's been amazing to see how accurate the forecast actually was that in the middle of the day, you had a ton of solar generation. And in some of the shoulder months, March and April, even October, November, there wasn't, it's pretty mild in California in those months generally. And so you don't have a lot of cooling load. You don't have a really high demand on the grid, but you have a lot of intermittent generation that's being put onto the grid. And that is lowering the marginal price. And so what they forecasted was that the price would kind of dip in the middle of the day and the net load would dip, the load net of renewables that must be satisfied by traditional assets. And so when you kind of overlaid a bunch of these forecast curves, you had to structure a plot that kind of looked like the shape of a duck, where you had this big belly in the middle of the day. And that has played out remarkably accurately to the forecast. And it's also shown up across other markets in the US. Texas is starting to experience a duck curve. I've seen a really extreme drawdown of prices in ISO New England. You don't really think of New England as being a hotbed of solar, right? I always think of New England, especially in the winter months, as being kind of cloudy and dreary. But even New England is having a duck curve type of phenomenon. So to get back to your question of, how concerned should we be about this phenomenon? It's certainly going to happen, nationwide. It's going to happen in response to solar adoption. There's a lot of solar being deployed, and it's all intermittent. And batteries, where we are today, I think with the lithium-ion battery technology, we mentioned that it's very efficient. It's very good at providing frequency regulation, but that is really geared around short bursts of power and not a ton of energy, right? Energy is power times time. So it's sustained power output for long periods of time. Batteries are not great at that. And when we look at energy arbitrage and we say, well, I'll just plop a battery down and just shift all this energy over here, it's really expensive to do that because you have to overbuild the battery because its energy capacity is not, it's not wonderful, right? It becomes very expensive on a megawatt hour basis, whereas it's much more economic on a megawatt basis. So I think that this duck curve phenomenon, or this phenomenon where you have an oversupply of renewables at a certain point in the day when the grid doesn't necessarily need all that energy, we need to find ways of mitigating that. And you mentioned responsive load. I think that's a really important component of this. I think that it's, from my perspective, I don't see a future where we can solve the problems that we have on the grid without some type of behavior modification. Some of that can be automated, right? In terms of like, when do we charge our electric vehicles? Well, if everyone comes home and plugs them in all at the same time, we're going to make a mess. But if we can figure out a way to just automatically schedule that through demand response programs and different programs like that, that's one way to kind of even that out. But I think the combination of responsive load, so the idea that you can just not consume energy, or at least as much of it, and then shift your consumption to different times, that combined with flexible resources like battery and hopefully other more energy dense storage technologies can help get us there.
Great. And when you think about the duck curve and we think about parameterizing this, there's a solar capture rate. Do you have a sense of what that is and where that's trending? My sense today is that it's, if I had to guess, maybe 75% and falling, meaning ratio of production weighted solar value versus round the clock power. Is that a metric you use, and where do you think that's trending?
Yes, it definitely has been trending down in a lot of markets. California, Texas is seeing a lot of solar adoption right now and is very rapidly developing kind of a duck curve, even the northeastern markets, as I mentioned. Capture rate is essentially the concept of, exactly what you said. It's a production weighted price for the production of a particular renewable facility. Or you can look at capture rates at a project level, right? Where you have a renewable facility and you have various different financial derivatives in place to hedge that renewables. And the trend is definitely down. And I think it's an important metric to kind of benchmark a particular asset or project relative to the market. Because, that rate, if the capture rate is essentially the ratio of that production weighted average price of generation divided by the flat market price over the same period. And you can look at this in different slices, right? You can look at an on-peak capture rate and an off-peak capture rate. Really, the off-peak is more relevant for wind. You can look at a weekend capture rate. You can look at a capture rate of the physical asset plus various different financial hedges. And that's something that actually a lot of our customers are doing with our software, is looking at those capture rates for either prospective assets and comparing the capture rate as a way to prospect new generation that they could potentially purchase, or new projects that they could develop, but also looking at capture rate as a way to benchmark portfolio hedging strategies and to come up with a prospective hedging strategy and say, okay, what I'm really looking to do is, one, mitigate risk, but two, potentially increase my expected capture rate. And there can be some strategies that are using shaped products or even financial transmission rights or congestion revenue rights products to kind of shore up some of the shape risk that we've been talking about.
And that leads to me where this conversation had my mind going is the users of this data, because it's pretty analytical, right? I mean, I can't imagine I'm sitting over at my big data center and I'm doing power buying for my company that I have all these skills right out the box. So is it the developer, or is it the power? Who's using this data and who's making these strategies based on what you're doing?
Yeah, so in many cases, it actually is folks at the organizations, and it's maybe a good opportunity for a shameless plug for cQuant. Is that one of the things we've been really focused on is taking this analytics, providing a really sophisticated analytics offering but condensing it in a way that you don't have to have a PhD or, a master's degree in applied math or economics to be able to use the tools, right? I think that there's a way of offering these analytics in a transparent and very open way, so that procurement managers at some of the big tech companies are using this tool. In some cases, they may have an actual risk management department, but that's only at the largest of organizations, right? But being able to understand the idea of shape risk and capture rate and basis risk and all these different components, with a good analytical framework in place, it just becomes configuring the details of your portfolio and querying the system to say, what does this look like for me? And how am I exposed? Because every portfolio is a little bit different. So I would say that, the other component of this is that most of the folks who are coming out and working in the industry today have some level of analytical training through their college degrees today. That definitely was not the case 15 years ago, right? Analytics has become so mainstream, and that we're seeing folks coming out with business degrees that know how to program in Python and R. And that is a huge enabler for analytics consumption, because it makes folks a little bit more comfortable with data, right? I mean, almost everyone knows how to use Microsoft Excel, but then even going beyond that into some kind of platforms that allow you to wrangle much larger data sets, that's been a huge enabler to be able to really develop an analytics-driven business strategy, and to say inherently these things are analytical. We're not going to be able to manage a portfolio of complex power purchase agreements without understanding data and leveraging data, because that's what these things are, right? At the very beginning of the discussion, we said, really, this is a portfolio of statistical distributions. And we have to understand those statistics in order to understand the risk and value that portfolio has.
Now that you have a customer, whether that's a developer or a corporate buyer, they've got their renewable energy positions, they've got a data analytics platform to start to understand their basis, their shape exposure against load. What can they do? What are the financial products that they can then go purchase to manage this load? And you threw out a few, so I want to hear at least one. You mentioned congestion revenue rights, that one, or maybe another one that's popular to actually take action to manage some of these risks.
Yeah, so CRRs, congestion revenue rights, and FTRs, financial transmission rights, and their associated options. You can either have obligations or options. Those are some components that some of our customers are using to manage basis risk, because you can sign a contract for a CRR or an FTR that pays off based on the nodal basis, essentially, between a hub and a node, or even between two different nodal locations. Those contracts are not extremely liquid, right? So they're a little bit harder to transact. They certainly come with a lot of risk, so you really need to know what you're doing when you're transacting in those contracts. But the idea of risk and risk management is that not all uncertainty is bad, right? If it were, there'd be nothing that we could do with it. But there's offsetting uncertainty, right? When you look at a corporate customer who runs a data center, there's all kinds of uncertainty in the cost of the power that they're going to have to pay to run that data center just by their native position. They've already got uncertainty in their portfolio. So if you can sign contracts that offset that uncertainty, those contracts themselves, if you look at just a power purchase agreement, it has a lot of risk, but it's an offsetting risk to a large extent, right? It's an uncertainty that cancels the uncertainty in the native portfolio. And it really goes straight back to modern portfolio theory, where you look at anti-correlation between different portfolio components that creates diversification. So CRRs and FTRs, that's one component. There's a lot of structures that are being baked into PPAs themselves today that are risk management structures, things like $0 minimum clauses that expose the settlement price to nothing lower than zero, right? You can have negative pricing. If you're long a PPA, when the prices go down, that's bad for your position. But some of these deals will threshold that settlement price at zero. You can even have collared structures where you may give up a little bit of upside in exchange for a better price on the PPA. You can have proxy generation swaps. You can have volume firming agreements that give you a fixed shape. You can even have basis buyback provisions where it says, okay, the off taker of the power purchase agreement will take the first $1 million of basis exposure within a year. But if things get really bad, we're going to split it 50-50 with the developer. That's a new structure that we've been kind of seeing. And so really, to assess what can be done. And I think that's really the root of the question, right? Is we can understand all these structures, we can understand the portfolios. What can we actually do about it? And how do we combine in an optimal way shaped products and FTRs and CRRs and power purchase agreements and diversified portfolios? How can we manage this very intentionally from the outset? And really, the biggest driver there is having an analytical framework that can allow you to kind of do what if scenarios on the portfolio composition as it's being composed. And that's one of the most important things I think that cQuant does for our customers today.
Brock, what a tremendous journey. In a short conversation, you've managed to take some really, really complex ideas and concepts on the grid, boil them down into accessible language, and then give us a hint at that there's more to come. And so it's inspiring in this conversation to recognize risk is real. It's out there, but we don't need to be afraid of it. There's tools to understand and products to help manage that. So this has been a really fantastic conversation. And I thought you did a great job of boiling down some complex concepts here. So thank you so much. Really appreciate the time.
Yeah, thanks to you guys as well, and to Insider's Guide for having me today. I think these are really important topics, as the grid continues to evolve, and there's always new challenges that are posed by new technology, and there's creative solutions to those challenges, right? That's one of the great things about our industry, and it's one of the great things about being involved in energy today. It's just things are moving so quickly, and I feel, personally and as an organization with cQuant, really fortunate to be where we are today to be able to assist the industry. So thanks so much for the conversation. It was really enjoyable.
For our audience, we hope you've enjoyed this conversation as much as we did making it. There's a reason we call the show Insider's Guide to Energy. I don't think you get this kind of conversation a lot of places, so I hope you enjoyed the depth and the technical background. If you did enjoy the content, don't forget to subscribe, follow us, find us on Facebook, and we'll see you again next week. Bye-bye.